this is 11.2. We already learned what depreciation is, so this is the second method that we're going to be looking at today, which is called double declining, also known as accelerated. Okay? Now, we already talked about the 5 components, right? So all of these 5 components, once again, are going to carry over throughout the rest of this chapter because it's depreciation. You need to have all 5 components in order for you to complete and calculate depreciation. Okay? And again, we talked about activity-based earlier. Now we're moving on to accelerated, or also known as double declining method. Okay? So let's talk about why we would use double declining, okay? Double declining is essentially where when we buy our fixed assets, right, the idea that we want to depreciate it twice as fast is because usually in the beginning of its life, you tend to use it more often than you would in the later of its life, okay, in the last years of life, right? So a great example would be a laptop, right? Especially when you're going to school, you're frequently using it more often every single day, but as you finish school, right, that laptop sometimes get used once in a while. Sometimes it just sits there. Sometimes, right, you don't have a means to have to turn it on. And that's exactly the same idea here, is that you tend to use the asset more frequently in the beginning of its life than you would towards the end of its life. And that's why we need to depreciate it twice as fast, because you're using it twice as much in the beginning versus towards the end of its life. So that's the main idea of why would we use double declining. And the best example, or a means to use double declining is technology. Because a lot of nowadays, right, technology, same thing too, is that every year there's something new, greater, better that releases every year. In this case, right, when we're looking at using technology, you're more likely to use it in the beginning of its life than towards the end of its life. Just because, the idea of the processor gets delayed, right? When it takes too long to turn on, etc., right? The battery is worn out. Things like that. You end up using it more frequently in the beginning, and you end up depreciating it a lot quicker. So that's why you're going to be double declining, meaning you're going to depreciate it twice as much. So as I mentioned before, right? The difference between the 3 methods is the first 3 equations, okay? So here, the depreciation basis is actually going to be the beginning of the year book value, okay? So meaning every time we calculate our book value, that's going to carry over into the next time we depreciate it, okay? And then every year, we depreciate it based on its change, okay? And that means the depreciation basis is going to change every year. So then after that, then we have to determine what the depreciation rate is. The depreciation rate is going to be 1 over its estimated useful life, okay, times 2, because you're going to depreciate it twice as fast, because that's what double declining is. Not only depreciating it once, you're depreciating it twice, okay? And then depreciation expense is going to be the basis times rate, okay? And then accumulated depreciation is the same. It's the previous year's accumulated depreciation plus current year's depreciation expense. And book value is also the same. It's the cost of the asset minus the accumulated depreciation. And again, book value at the end of the life must be equal to the salvage value. Okay? So let's take a look at an example here where we bought a machine, once again, for $15,000. Its salvage value is $2,500. Estimated useful life is 5 years. The number of units that it could produce is 10,000. And the date that we placed into service is January 1st. Okay? So in this case, the same exact scenario, except now I have 2 components. I have an estimated useful life and a units that it can produce. Now, because we're using double declining, we don't care about how many numbers that this machine can produce. We care about how long it's going to last me. What's the estimated useful life that this machine is going to carry on for? Okay? So in this case, depreciation basis, once again, is going to be your beginning of the year book value. In this case, the book value is going to be what, for the first year, is going to be whatever you purchased it at. So right now, my asset that I purchased it at is going to be $15,000. So in this case, that's what it is. The very first year is going to be the asset cost, okay? The years after that, you're going to carry the book value that you calculated every year because it becomes the beginning of the year, okay? And we'll talk about that in a few seconds. So in this case, 15,000 is what I began my book value at, okay? Now the rate is going to be 1 over its estimated useful life times 2. So in this case, my estimated useful life is 5 years. So what I'm doing here is I'm taking my depreciation basis, right? And I'm going to divide it by the number of years that it can last me so that I can determine year 1, this is how much depreciation I must take. Now in this case, because I'm depreciating it twice as much, right? I need to also include times 2. So 1 over the estimated useful life, which is 1 over 5, times 2 is going to give you 0.4, or also known as 40%. Okay, so that means you're going to depreciate it 40% of the time. Okay, so 1 over 5 equals 0.2, times 2 equals 0.4, which gives you 40%. Okay, so that means the next step here is going to be determining the depreciation expense. Depreciation expense is going to be the basis times the rate. So I'm going to take my 15,000 and I'm going to multiply it by 0.4 or 40%, if you whatever number you know how to calculate this at. You're going to get a total of $6,000, right? That's 40% of the $15,000, okay, which is $6,000. So in this case, accumulated depreciation is going to be $6,000, right? Because you have no previous years, but your current is $6,000. And then now you're going to determine what your book value is. Your book value is going to be your asset cost minus your accumulated depreciation. So 15,000 minus 6,000 is going to leave you with $9,000. Now, this is the book value at the end of year 1. So if the book value for the end of year 1 is $9,000, then that means when you begin year 2 is going to be also what you ended in the first year. So in this case, you're going to take this number 9,000 and it's going to be placed right here because the end of year 1 is the same thing as the beginning of year 2. Okay? So therefore, you're going to carry that 9,000 over into your basis. And then everything's going to be the same after that, right? You got to figure out what your rate is. Your rate is 1 over the estimated useful life times 2, which is going to give you 40%, right? Then you're going to multiply that 40% by the 9,000, and you're going to get 36,000 for your depreciation expense, okay? And then you take your 36 plus your 6,000 to get you total of 9,600, right? As your accumulated depreciation. And then you're going to figure out what the ending balance in your book value at the end of year 2 is going to be, right? Which is your asset cost of 15,000 minus the 9,600, and you're going to get 5,400, okay? And then it's going to carry on to the next one and the next one, okay? Now, here is something that you want to also notice is that, notice here on year 4, my book value is 1,944. we already said that no, that cannot happen because this fell below salvage value. My salvage value was 2,500. So in this case, because I depreciated twice as much, my asset didn't even last for the 5 years that it's supposed to last, right? Because, and that's true, because you are depreciating it twice as much. Therefore, it's not going to last as long if you use it too much in the very beginning of its life. So that's the idea here, where I used it so much that it didn't even reach its 4th year because it fell below salvage value. It went under the $2,500 limit. So in this case, because we have the assumption where book value must always equal to salvage value, right? Therefore, we need to revert and go back in time and recalculate all of this, okay? By calculating backwards. Now, when we deal with math is very flexible, okay? Math, right? 1 plus 1 equals 2 is the same thing as 2 equals 1 plus 1, right? Or it could also equal -1 minus -1 equals -2, right? Or in this case, right, 2 minus 1 equals 1, right? You can flip and reverse the equations to fit so you can solve for what you need to solve for. Now, in this case, we are given the depreciation expense, we are given the accumulated depreciation, and we are given book value, the formulas to this. Now, if I have to know that my salvage value must equal 2,500, right? My formula for book value is my asset cost minus my accumulated depreciation. In this case, if my asset cost, right, was 15,000 minus X is equal to 2,500. I just do simple math. What number will fit in between here to make this equation true? How do I go from $15,000 all the way to 2,500? Simple. Do the math, right? You could take the 15,000 minus the 2,500 and you'll get 12,500. Okay? At least that's what we know. Once we have this, right, we got to work backwards once again because now we need to solve for what my depreciation expense is going to be for year 4. So in this case, right, what I know the most is that at least for the accumulated depreciation, it's going to be it's going to be the previous year's depreciation minus the accumulated depreciation is going to be the previous year's plus current years of depreciation expense, right? So in this case, you already know how much the previous amount is. And because you worked backwards, right? You already figured out what your accumulated depreciation was. It was 12,500. So in this case, now I need to plug my numbers in, okay? 12,500 is equal to my 11,760 plus X, right? So in this case, all I do is have to subtract these two numbers to get me my depreciation expense. So in this case, I take my 1250 or 12,500, I minus out my 11,760 to get a total of $740. And that's what I need to do. If my salvage value falls below book value, I need to work backwards to solve for my depreciation expense for the end of its last year. Okay, so that's the rule here. Okay, so then everything pans out, right? You have your book value ending at salvage value. Okay, and here, unfortunately, the asset did not last 5 years because you depreciated twice as much. So therefore, same idea, right? if you use it so much in the very beginning of its life, then you obviously know it's not going to last for however long it's supposed to last. Okay? Any questions here?
No.
Okay. So again, right? Notice this that we didn't last 4 years. We only last 4 years, not 5 years. The depreciation basis is going to change every year, right? Because it is the book value. And of course, the 40% is going to stay the same. So once you figure out what it is, it will stay the same. And then, yep, depreciation basis times rate is going to give you a depreciation expense. And at the end of its life, it should equal the salvage value. Okay. So once again, how am I going to journalize this? For the journal entry is going to be exactly the same. Okay. The only difference is because I'm using the double declining method, then the value in my debit and my credit is going to be different. Okay, so in this case, depreciation expense and accumulated depreciation is going to be the same. It's universal throughout all 3 methods. Okay, and then this time, right, all I have to determine is how much did I depreciate for the first year. In this case, $6,000. Okay, and then same thing with the second year, 3,600. Okay, so every entry is going to be different every year. Okay. So then let's talk about what happens when you have to deal with partial years. Okay. This is where, because when you're trying to figure out how much depreciation expense, you're actually solving it for one whole entire year. And in this case, that's not true, especially if you have to think about how old each asset is. Because again, the day that you put it into service is when you actually start counting its age. Okay? So then again, so this example here, we bought a machine for $10,000 with a salvage value of $2,500. Its useful life is 5 years. The number of units it can produce is 25,000, and the date that we placed into service was October 14. So in this case, right, October 14, right, it fell before the 15th. So therefore, we use this asset for more than 50% of the month. So therefore, we're going to start depreciating as of October, then we're going to do November, then we're going to do December. Assuming that when we calculate our depreciation, we're doing it at the end of the year, December 31st. So in this case, if I place it, my asset in service as of October 14, I have to calculate depreciation for October, November, and December. Okay? So therefore, it's only 3 months old. Okay? So that means I gotta treat it like it's 3 months old. So how do I do that? Well, in this case, right, for the first year depreciation, assuming it's done at the end of the year, right, here's the idea here. We bought the asset, right? So again, we're going to figure out this, the depreciation basis, which is once again the beginning of the year's book value, which in this case is $10,000 because that's how much I bought it for, and that's the very first depreciation. So whatever the asset cost is going to be the first year's book value. Okay, so 10,000. Then we're going to figure out what the depreciation rate is. So it's 1 over its estimated useful life of 5 times 2, which we've already calculated before, right? It's 0.4. Okay, 40%. And then my depreciation expense is going to be the rate times the basis, which is going to be, so 10,000 times 40% is going to give you $4,000. Now, once again, this $4,000 is for the entire year. And in this case, is my asset even 1 year old right now? No, right? It's 3 months old. So in this case, I can't use this $4,000 because think about it, right? you are like if you're gonna have a kid, right? Are you gonna buy it oversized diapers when it's only 3 months old? No, you're not gonna buy 1 year. You're gonna buy 3 month old, right? So in this case, you have to also adjust the depreciation expense as well, because in this case, this is for the depreciation for the whole year. It's not even 1 year old yet. So in this case, we need to adjust this 4,000 to fit it so it does match the age. Okay, so in this case, right, we need to figure out, well, if we're doing in comparison to years, right? October, November, December is equal to 3 months. 3 months out of a year is 3 out of 12, which in this case goes through evenly, right? It's 25%. So in this case, 25% of the year. So therefore, what I have to do is I got to take my depreciation expense, right? I'm going to take my 1,000. I could take my 4,000 and divide it by 4, or multiply it by 0.25, or I could take my depreciation. I could take my rate and also divide that by 4. Okay, so it's 10% of the rate, or I could just simply take the total of the depreciation expense and multiply it by 25%, which is going to give me 1,000. Okay. Okay, so 4,000 times 0.025, okay, is equivalent to $1,000 of depreciation expense. Okay. So then how do I journalize it? Same thing, straightforward. It's going to be for 1,000. And that's only for the first year. But remember, when we think about years, we have to think about how old my asset is. Okay? Any questions?
I have a question. Can we move back a slide?
Which one?
The one before that one.
Okay.
So the last part where it's the 40% times 10,000, why do we do times?
Because this is the basis times rate to get you to depreciation expense.
So we do, okay, yeah, that's how we did it. And then you do 4,000 times
Mm-hmm.
2.5. Yeah, I was just trying to understand why you would multiply.
You could multiply, or, again, math is very flexible, right? You could also multiply 3 divided by 12. In this case, you already know this is 1/4, right? 3 divided by 12 is also known as 1 divided by 4. So you could also do that too. You could take your 4,000 divided by 4. You'd get the same answer. So that's the thing about math. It's complicated because there's so many ways that you could solve the answer. So in this case, however, you can figure it out. Now, what I recommend you to do is, if you have complicated numbers such as 5 out of 12, do not convert it into a decimal. Just multiply it by 5 and divide the whole thing by 12, and you'll get the same answer, an even more accurate answer. Okay? Because 5 divided by 12, right, you're going to get like 6, 6, 6, 6, 6, 6, 6, 6, 7, right? You don't want to have to punch in all those 6s, right? So in this case, you could just multiply it straight across. So that's the rules about math as well, is that when you have a fraction, right, it's like you're multiplying the whole thing across, and then you're dividing the whole thing by 12. That's the same thing.
All right, thank you.
Mm-hmm. So that's how you get 1,000. Okay. So chapter review. Okay, we talked about double declining, where we normally use this because in the beginning of its life, you tend to use it more often. So technology is going to be one of those examples that you would most commonly use double declining for. Okay, your book value must always be equal to salvage value, and if it doesn't, then you gotta reverse these formulas to solve backwards. Okay, but this is only if your salvage value falls below our book value falls below salvage value. Okay, if it doesn't, then you don't need to worry about it. Okay, but this is the formulas that you need to know for this section. So again, I'm not gonna have you memorize it, right? That's the purpose of having the PowerPoints available to you, is so that you can have this in front of you to be able to calculate this. Okay, so there you go. So let's go ahead and do the exercises real quick, and then we can call it a day. Okay. So here we are, question number 1 through 3. Same ordeal, except the difference is we're going to be using a different method. Okay. So number 1, right? You purchased a cash register for $300, okay, with no salvage value, and its useful life is 5 years, okay? And it can print up to a total of 5,000 receipts, okay? And of course, you put this cash register in service on January 8th, okay? So let's determine what was the asset that I bought.
Cash register.
Okay, how much did it cost me?
$300.
$300. What's my salvage value?
No, none.
Yeah, it's 0. And what's my estimated useful life?
5 years.
5 years. Okay. And when's the date that I placed into service?
January 8th.
January 8th. So am I going to depreciate January or February?
January.
You have to depreciate in January. So in this case, assuming that we are depreciating at the end of the year, December 31st, that means the first year is going to be for the first year. Okay? So depreciation basis. Okay? What's my depreciation basis?
300.
It's going to be 300, right? Because in this case, it's the beginning of the year book value, right? In this case, first year, it's going to be whatever the amount that you purchased it for, so 300. What's my rate going to be?
$40.
40%, right? So it's 1 divided by the estimated useful life of 5 times 2. So you should get 40%. Okay? So then, what is going to be my depreciation expense for the first year?
300.
Times
40%. Times 120.
$120. Okay? So therefore, what's my accumulated depreciation for the first year?
$180.
180? No. So in this case, right, my accumulated depreciation, right, is going to be my previous year's accumulated depreciation plus my current year's depreciation expense.
So 120.
It'd be 120. Good. Okay. Your book value is going to be your asset cost of 300 minus your accumulated depreciation.
180.
Okay, so this one, in this case, this was the 180. Right? Because you're going to take your asset cost of 300 and you're going to minus your accumulated depreciation of 120. So yes, you get 180. Okay? So then, what is your depreciation basis for year 2?
300.
Not 300. So in this case, this is the beginning of the year book value.
180.
It's going to be 180, right? So the end of book value at year 1 at the end is going to be the beginning of year 2. So in this case, this is 180. Okay. What's my rate?
40.
It's going to be the same, right? It's still going to be 1 divided by the estimated useful life times 2. So it's going to be 40 throughout. Okay. So this time, what's my depreciation expense going to be?
72.
72, okay? Which will give me an accumulated depreciation of
192.
192, right? 120 plus 72 gives me 192. So then what's my book value going to be now?
108.
108. Good. Okay. So what's my book value? Or what's my depreciation basis for year 3?
108.
108. I'm going to carry it over. Good. Okay. Times 40%.
4320.
4320. Okay. Accumulated depreciation.
23520.
Okay. Which will give me a book value of
6480.
good. Which then becomes my book value for year 4. Okay. Times 40%.
2592.
2592, which will give me a total accumulated depreciation of
26112.
26112, right? We're going to take 2592 plus 23520 to give you 26112. So therefore, what's my book value going to be?
3888.
Okay. So let's carry on to year 5. Okay. Rate's going to be 40%. So what is going to be my depreciation expense for year 5?
1555.
1555, giving me accumulated depreciation of
27667.
giving me a book value of
2333.
2333. Now, if you keep on going, which you can, you'll eventually will get to 0. Okay, in this case, 0 is one of the factors that you're just going to keep calculating until you get to 0. So you're going to do another half of 23, and then another half of that, and then another half of that, another half of that, right? Until you get to 0. Now, in this case, right, if this was a cash register, yeah, maybe your cash register can go beyond its estimated useful life, right? But again, the more, because you use it so frequently in the beginning of its life, by the end of 5 years, do all the buttons work at that point? Does your receipt tape roller work at that point in given time? Does it properly open and shut your drawer, right? Does the spring work inside? In this case, it might not work as good as it was when you first bought it, right? So in this case, what you can do here is you can keep going, because if it's still in good condition, you can still keep going because your book value is nowhere near salvage value. Okay, it's at $23.33 right now. So So you can keep depreciating it as long as you'd like until it gets to 0. But like I mentioned, right, once it's past its estimated useful life, you can't guarantee that this machine is going to still keep working, right? If it still keeps working, go ahead and do it. But in chapter 11.5, we'll talk about what happens when you reach the end of its life. Can I choose to dispose $23.33? At this point, you should, because at the end of the day, maybe buying or investing into a new cash register might be in your best benefit than continuing to use the old one that you're using, and you're going to have problems later on in the future. So in this case, this is only $23. At least you use, your machine to its maximum capacity of its estimated useful life, right? It reached its 5 years. It's done with its life. You could choose to either continue on with it, or you could choose to get rid of it. So in this case, it's only $23 you're losing out. And that $23, again, could potentially, right, instead of it's just a $23 write-off loss here, you could still end up getting a new machine, or you can actually replace it for a better deal. Okay? So that's that there. So now I need to journalize my entry for the first year and for the second year. So how should I journalize this?
Depreciation expense and accumulated depreciation.
Good. All right, so what's the depreciation expense for the first year?
120.
120. And then what's my depreciation expense for I don't know why. I don't know what happened here. What's my depreciation expense for the second year?
72.
$72. For 72. Good. Okay. All right. See, it's getting more easier, right? Okay, so let's go ahead and do this last one right here. Okay. So in this case, right? Make this a little too big. In this case, we purchased an asset. Okay, we purchased a computer for 1988, which includes all fees. Okay, with a salvage value of $200. Okay, its useful life is 5 years, and you put this computer into service on August 25th. Assume that the adjustment entries are made at the end of the year. Okay? So in this case, we bought a computer, right? How much is my computer worth?
$1,988.
Okay, what's my salvage value?
200.
Okay, and what's my estimated useful life?
5 years.
Okay, and when is the date that I placed this into service?
August 25th.
So when do I actually start depreciating it?
September 1st.
September, October, November, December. that means it's going to be 4 months. Okay? So in this case, my depreciation basis is going to be
1,988.
good, right? Because that's the beginning of the year's book value. Okay? What else? What's my rate going to be?
40% all the way down.
Good, right? It's 1 divided by 5, which is the estimated useful life times 2, which is going to give you 40%, which is going to go all the way down. Good. So what's my depreciation expense going to be for the first year?
$795.20.
$795.20, okay? Now, in this case, right, that's for a whole year. In this case, I have to adjust it because how old is my asset?
4 months.
It's only 4 months. So in this case, I have to adjust this and figure out what 4 out of 12 is, right? Because that's how much it is in 1 year. So 4 out of 12 is a third of a year. Okay? So I could take this and divide it by 3. I could times it by 4 divided by 12, whichever way that makes it easier for you. So in this case, what should be my depreciation expense instead now?
265.07 or 06.
Good. 07's correct. So we run it up. Okay? So then, what's my accumulated depreciation?
265.07.
Okay? Which will give me a book value of
1,722.93.
Right, you're going to take your asset cost of the 1988. You're going to subtract the 265 for the accumulated to get you 1722.93. Right. So what's my book value going to be for year 2? Or in this case, what's my depreciation basis for year 2?
1722.93.
And carry it over. Okay. So what's 40% of that? Now, this case, you're going to be depreciating it for a full year now because now that you depreciated for 3 months or for 4 months, so now you're going to actually depreciating it starting January all the way to December. So in this case, for a full year. So how much is this going to be?
689.17.
Oops, sorry. Okay, good. 689.17, which will give me a accumulated depreciation of
954.24.
954.24, which will give me a book value of
1,033.76.
good, which will carry on to the next year. So what's 40% of this?
413.50.
413.50, which will give me accumulated depreciation of
1,367.74.
okay, which will give me a book value of 1988 minus 1367.
620.26.
Good. So which will carry on to the fourth year. Okay, so what's 40% of that?
248.10.
Okay. Okay, which gives you 1615.84, which will give you a book value of
372.16.
372.16. Okay, which will carry over to the fifth year. Okay. What's 40% of that?
148.86.
Okay. Okay. So then here your book value ends up being 223.30. Now question to you. Can I go on for another year?
Yes.
Yes, right? Because first off, how old is your asset?
5 years, 4 months.
4 years, 4 months.
Yes.
So that means it still has 8 more months to go. So in this case, let's go ahead and carry this amount over, right? So if I do 223.30 and I do 40% of that once again, right? How much is 40% of 223.30?
89.32.
89.32. Okay, which will give me an accumulated depreciation of
1854.02.
okay, which will give me a book value of 133.98. Can I have this as my book value?
No.
No, we can't because my book value or my salvage value is $200 and this is lower than $200. So now I need to work backwards because that means these numbers are not correct. We can't use these numbers. So let's work backwards now. Okay? Because in this case, my salvage value must be $200. Okay? If my salvage value is $200, okay, what is my accumulated depreciation then? What's my formula for this?
Cost of asset minus accumulation depreciation.
Okay, that's your book value. Okay, so in this case, my book value is 200. Okay, my accumulated depreciation is what I'm trying to solve for. And the cost of the asset, I know. My cost of the asset is 1988. Okay, minus my book value of 200. So what should be my accumulated depreciation now?
So it would be 17.
Good, 1788. Okay. All right. So now I need to solve for my depreciation expense. So what's my formula for solving for my depreciation expense if I have to work backwards? Okay. If I know my accumulated depreciation is going to equal my previous year's plus my current year's depreciation expense, then how do I solve for my current depreciation expense? If I know this, if I know that it's my previous accumulated depreciation, so 1788 is going to equal 1764 plus X, right? Then what is going to be my depreciation expense? So in this case, this formula would be your accumulated depreciation minus previous accumulated depreciation.
2430.
2330. Okay.
Okay.
Right? And that should be your end result on the 6th year. Now, okay, so that's one way that you could figure this out. But if you actually already knew this, that your book value right now as of year 5 was 223.30, and you need to get to 200, right? You could have just figured out that if you subtract the two numbers, it would have been 23.30 as your depreciation expense. But I'm teaching you to work backwards if you couldn't figure that out in the beginning. Okay. Last but not least, let's go ahead and journalize for the first and second year. So December 31st. What do we have here?
Depreciation expense and accumulated.
Okay. So what's the first year depreciation expense?
26507.
Okay. And then what is the depreciation expense for year 2?
689.17.
Good. Right? And that's how you do double declining. Much easier, right, than the first one?
Yeah.
All right, well, tomorrow we're going to learn 2 different methods, okay? Or in this case, it's the last method.